Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. We wish you a great year ahead. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. When we, look at Palantir, the first thing we really have to acknowledge is that the whole narrative has completely transformed.
Right. For years, it was all about these massive, almost secretive government contracts.
Exactly, that was the story. But now, the central thesis, the real engine driving everything, is their artificial intelligence platform, or AIT.
And AIP isn't just a buzzword they're throwing around. It's where the numbers are really coming from, right? It seemed to be reshaping how companies use AI in real time.
It is.
But why is it taking off commercially now? I mean, Palantir struggled for years to break out of that consultancy model. What's the competitive advantage? What's the moat?
Well, the moat is it's multi-layered.
Yeah.
And it's actually deepened quite a bit with AIP. Firstly, it's all about integration and data management.
Okay.
They've had these platforms, Gotham for government and Foundry for commercial, for a decade. They basically become the data nervous system for their clients.
So once you're in, you're really in.
You're really in. Once a company or an agency pours all its complex, siloed data into those systems, the cost, the time, the security risk of moving to a competitor, it just becomes astronomical. That's the first key. Massive switching costs.
So it's not like they're just selling a tool you can swap out. They're embedding themselves right into the critical infrastructure.
Yeah.
It's a huge distinction from, say, a standard SaaS model.
It is. And the second layer of that moat is really how AIP functions strategically. Your competitors, like Snowflake or C3.ai, they often offer really powerful tools, but the client still has to build the AI model on top of that.
Right. You need your own data science teams, which are expensive and hard to find.
Exactly. Palantir's AIP is designed for what they call model-on-data capabilities. It lets the actual domain experts, the manager on a factory floor, a logistics officer, build and deploy AI models directly on their live data. You don't have to be a coding genius.
That's fascinating. So it's cutting out the middleman and putting the power right into the hands of the operational user. It almost makes AI a utility instead of a specialty.
And that gives them a unique execution advantage. Think about their work with the U.S. government. They're already entrenched. They meet the highest security standards. That's a massive barrier to entry for anyone else.
A huge one.
So when a commercial client needs that same level of complexity and security, Palantir is already there. They deliver the full execution where others just give you the parts. That difference is critical to why we're seeing this explosive commercial growth now.
And the growth figures, they just speak for themselves, don't they? The Q3 2025 report. The big headline was that U.S. commercial revenue, it surged 121% year over year.
Incredible number.
And that single segment drove the whole company's revenue up 63% to $1.18 billion. So 121%. That's the proof right there that the AIP commercial thesis is working.
Absolutely. That figure validates the entire shift. It signals this recurring subscription-based revenue, not just lumpy government deals. And we're seeing the customer count is up 65% year over year, too.
It's broadening out.
It is. And that increase in the client base is, the key ingredient for operational leverage, which brings us to the whole financial picture.
Okay, so the engine is running hot. But the big question for any investor is sustainability. Can they keep this going into 2026, or is the market getting a little ahead of itself?
Well, the forward guidance certainly suggests they think it's sustainable. Management raised their full year 2025 revenue guidance pretty significantly. It's now sitting at a midpoint of around $4.4 billion.
And that's about 53% year-over-year growth for the whole year.
A very robust 53%. And Q4 is guided strong, too, between $1.327 and $1.331 billion. They aren't just meeting estimates. They seem to be accelerating into the end of the year.
When a growth company accelerates revenue like that, the street immediately looks for profitability. And that operational leverage story really seems to be shining through here.
It is. The non-GAAP net income in Q3 hit 21 cents per share. That's a powerful sign that all those heavy fixed costs from building Gotham and Foundry are now being spread across a much, much larger commercial user base.
So each new dollar of revenue costs less to acquire.
That's the key connection. That efficiency is the foundation for the, frankly, impressive 2026 projections. Analysts are looking for revenue to hit $4.42 billion next year. That's another 54% growth, and an EPS forecast of around 79 cents.
Wow, so 54% growth on top of 53% growth. That is a huge ask, but it sounds like it's really underpinned by that U.S. commercial engine.
It is. We expect that segment alone to clear $1.433 billion in 2025. It's a core pillar of the business now, not just some side project.
And what about the balance sheet? Can they fund this kind of growth?
They can. They have an extremely healthy balance sheet, backed by robust free cash flow. This is crucial because it means they can fund all their R&D and AI themselves without taking on a lot of debt or diluting shareholders. In this kind of environment, being a self-funding growth engine is a massive advantage.
Okay, we've established the fundamentals are really strong. Let's pivot to how the street sees it. How does all this translate into the stock's price action and the technicals?
The price action has been, well, definitively bullish. The stock is trading around $194, which is a rally of over 150% year to date.
Just this year, wow.
And if you zoom out to March 2024, it's over 650%. So the market is clearly pricing in the success of this commercial pivot. The momentum is just undeniable.
For our listeners who look at the charts, momentum stocks like this can be volatile. Are there any key technical support levels they should be watching?
Yeah, good question. We've seen clear accumulation around the moving averages. The 50-day moving average is the critical near-term support, right around $179.93.
And longer term?
The 200-day is down around $146.93. The fact that it's trading so consistently above both of those indicators confirms what we call a strong accumulation phase. It's structurally like a golden cross, which is a very bullish signal.
So a strong technical picture confirming the fundamental story. But this leads us right into the valuation problem, doesn't it? This kind of growth and momentum always comes with a steep price tag.
Precisely. You see that confidence in the high-end analyst projections, like Wedbush setting a $230 price target based on the success. But there is a counter-narrative, and we have to look at it, and it revolves entirely around valuation.
And this is where Michael Burry comes in, right? The big short.
And in this case, yes, the tension comes from him. The disclosure of his significant put options on the stock really provides that essential check on the market's enthusiasm. His move is driven by one thing: the fear that the growth rate just can't justify these multiples.
Let's put those multiples into context then. What are we looking at?
When we talk about the primary bear case, the numbers are, well, they're pretty eye-watering. A trailing PE ratio of 435.
435.
And a forward sales ratio of 125. These are not just high, they're extreme. We haven't really seen valuations this aggressive since the peak of the 2020 cloud software boom.
So the market is pricing in near perfection. Any slip up, any deceleration, and that 435 PE makes the stock incredibly vulnerable.
Acutely vulnerable. If they miss that 54% revenue target for 2026, the multiple compression could be severe.
And what about other risks beyond just the high valuation?
The secondary risk is still competition, from firms like Snowflake and C3.ai. Now, that AIP moat we talked about, the integration, the security, the switching costs, it manages this risk well, but it doesn't eliminate it.
So if a competitor manages to build a similar end-to-end layer,
it could erode Palantir's edge. But for now, the speed of AIP adoption is a pretty robust defense. The market seems willing to ignore that risk as long as they keep executing.
Okay, so let's look ahead. For an investor focused on the next 3 to 6 months, what are the immediate catalysts they should be watching for?
The most critical event is the Q4 2025 results. We expect those in early February 2026. Beating the revenue consensus is important, but the market's real focus will be on the guidance for 2026.
Any further raises?
Any further upward revisions to revenue or EPS guidance, that's the fuel this rally needs to keep going and to, start to grow into that valuation.
And beyond the earnings report, are there any sort of more speculative catalysts that could change the long-term story?
There are a couple. First is long-term government visibility. Programs like ShipOS and other Army contracts, they provide this durable floor of revenue. Success there can unlock massive new defense spending.
And the second one, the big moonshot scenario.
That's the highly speculative $1 trillion valuation thesis. The idea is that AIP achieves almost ubiquitous adoption across major enterprises, fundamentally changing how they operate.
To hit $1 trillion in 2 or 3 years, that would require, 50% growth for several more years?
At least. It's a huge moonshot.
Yeah.
But it illustrates the kind of dominance that investors are currently pricing in with that extreme PE ratio.
So bringing it all together, Palantir is clearly a leader in AI infrastructure. The whole investment thesis today really hinges on them continuing that U.S. commercial surge, that growth is the only thing that justifies these stretched valuations.
I agree. The core investment horizon has to be a multi-year commitment. You have to be focused on that earnings acceleration through 2026. If they execute on that 54% growth and hit that 79 cents EPS target, the current valuation will look a lot less daunting in hindsight.
A complex picture for sure, and one that demands a lot of due diligence. If you found our analysis useful, make sure you subscribe to Smart Wealth with Joshua. We'll be back tomorrow with more timely analyses.